Hello, everyone. My name is Addy, and welcome to today's Max Bell School of Public Policy webinar. This is part of the complexity seminar that I'm currently teaching. It's called Policy Making in a World of Business. We're excited to welcome our presenter today, who is one of our own McGill alumnus, Dr. Ernest Addison, the Bank of Ghana Governor. He will be presenting on implementing financial sector policy reforms in Africa. There's a little story behind Dr. Addison's presentation. Last fall, I was in Ghana with Dean Carlaville of Continuing Studies, and we got to visit Dr. Addison, and we had hoped to have him come to be here in person, but with the COVID-19 situation, it was not possible. But we're very grateful that Dr. Addison agreed to present this webinar today. So thanks very much, Dr. Addison, for still making yourself available despite the very busy schedule we know you have. I should mention, thank you. Yeah, I should mention that today's webinar is hosted in collaboration with McGill's African Studies program and the School of Continuing Studies. Before brief introductions, let me acknowledge the presence of His Excellency Joseph Aikwe Otu, Ghana's High Commissioner to Canada. We are grateful to him and his wonderful team at the High Commission, the staff at the High Commission. They have been very supportive of McGill's Africa outreach efforts, and we're very grateful for their continued support. I also acknowledge the presence of colleagues and scholars from the MasterCard Foundation program, and also certainly MPP, Max Bell MPP students, and a number of other guests. Thank you very much for being present with us today. Now to introductions. Most of you who have been attending the Max Bell webinars, you know Professor Chris Reagan. He's the director of the school. Professor Reagan will be moderating a question and answer session after Dr. Addison's presentations. Now, during the talk and after, please remember you can always add questions at any time in the question and answer box, and not the chat box, but the Q&A box, and that will facilitate the moderation. So now let me introduce our guest presenter, Dr. Ernest Addison. Dr. Addison was appointed as the governor of the Bank of Ghana in April 2017. He has over 25 years of experience, previously having served in various roles at the Bank of Ghana, as well as in multiple other international organizations. So these organizations, they include the West Africa Monetary Institute, WAMI, where he became chief economist. He also worked at the African Development Bank, where he was the lead regional economist for the Southern Africa region. So multiple other opportunities, other work that he's done. Now, Dr. Addison obtained his first degree in economics from the University of Ghana, followed by his MPhil in economics and politics from St. Edmund's College at Cambridge University, the UK. And he then matriculated at McGill, where he obtained his PhD in economics. And that's a very important part for us McGillians. We're very proud of that. His PhD was in economics with a specialization in monetary economics, economic development, and international economics. So everyone, ladies and gentlemen, at this point, let's welcome Dr. Ernest Addison. And again, Dr. Addison, thank you very much for being present with us today for the webinar.
Thank you very much, Nee, for that wonderful introduction. Let me say it gives me great pleasure to give this webinar at the McGill Max Bell School of Public Policy webinar series, where almost 27 years after leaving McGill, and to do so at a time when Professor Chris Reagan is a director. I remember how he inspired us all as PhD students nearly 26 years ago, having completed his PhD from MIT and coming to join the faculty at McGill University with Ingo van Long, Victoria Zinda-Walsh, Joseph Greenberg, and a few others that I can't quite remember. Today, I'm speaking on the topic implementing financial sector reforms in Africa within the context of the major global challenge that all of us are facing from the COVID-19 pandemic. I will try to talk briefly about the basis of the reforms and the need to have introduced them in the African context, and then zero into the Ghanaian experience over the last 3 years and what we have been trying to do in Ghana over the past 3 years. First is the issue of where the financial sector was in Africa in the 1980s, prior to the IMF and World Bank bringing in their financial sector adjustment policies. We had financial systems that were largely state-controlled, where there were a lot of controls on interest rate setting, controls, quantitative controls on credit allocation. And the thrust of the financial sector policies that the Bretton Woods institutions recommended in those days was the issue of liberalization of interest rates, abolition of credit ceilings, privatization of state banks, strengthening of regulatory and supervisory framework, with the objective to open up the banking sector to improve competition, enhance efficiency, and thereby promote growth. So competition was expected to enhance efficiency, lower the cost of financial intermediation, improve access to banking services, and then through that, improve the financial sector's contribution to growth. These measures seem to have worked. We were able to improve the economic environment in Africa. We saw much better allocation of financial resources in the 80s. But along with the deregulation of policies was the opening up of the banking markets to more foreign and private sector participation. And it was important to ensure that the banks were able to function effectively to achieve the desired objectives. This requires good economic policy. It requires effective banking supervision and regulation. It requires effective governance, and it also requires good policies broadly. Now, we did see privatization of some of the state-owned banks, which led to improvements in operational efficiency. We did see the introduction of universal banking to address the banking landscape. We saw the introduction of microfinance institutions as a form of addressing the smaller household sectors. And then we also saw the abolition of higher reserve requirements, and then the introduction of electronic banking and digital banking broadly. In addition to that, dominance of state ownership in the banks were curtailed. We also had many Pan-African banks spreading out within the continent, and improvements in banking competition, efficiency, and access. As with most deregulation policies, increased risk emerges as credit booms and innovation increases, and then supervisory efforts become stretched. This can affect the stability of the financial system. So it's important to ensure that the financial system is well regulated and well supervised. The market mechanism requires that framework with effective supervision so that banks would be able to achieve the desired outcome of improving growth. Now, similar to the developments that led to the financial crisis, the global financial crisis, development in the mortgage markets, which led to a credit boom and then eventually triggered a crisis in the US, which spread out globally. We in Ghana had a difficult economic environment within the period between 2011 and 2016. Weaker economic growth due to weaker commodity prices affected the performance of the financial sector. Oil prices were increased, and these oil sector depended very much on the banking sector for performance. And therefore, we saw a lot of non-performing loans in the banking system, impacting on the ability of the banks to intermediate credit. The rising non-performing loans led to capital erosion and presented significant stability challenges. In addition to that, a protracted energy crisis, the weakening economic growth, the large fiscal and current account deficits, rising inflation, a faster depreciating currency, rising debt levels had a very significant toll on banking sector performance, leading to, as I said, higher non-performing loans. In 2016, the Bank of Ghana undertook an asset quality review to try to understand the vulnerabilities in the banking system. The review revealed that there was severe deterioration in the asset quality of banks. There were provisioning shortfalls, and there was undercapitalization in the sector. And the sector was heavily dependent on the central bank for emergency liquidity assistance. The second asset quality review was also carried out, this time with external participation, which revealed that we had as many as 9 banks that had weak capital adequacy ratios below the required 10%, while there were about 2 banks that were completely insolvent. So when I got to this office in April 2017, we came in with a focusing on the macroeconomic policy, given the crisis that we had seen with higher inflation, higher depreciation of the currency, slower economic growth. We came in with a focus on trying to address the macroeconomic challenges that Ghana faced at the time with a typical stabilization policy framework to, in a sense, ensure that we had fiscal consolidation, re-anchor inflation expectations towards the single-digit inflation objective, stabilize the value of the currency. But then we were surprised to find out at the time that a major challenge was going to be the banking system. The banking system had quite a number of weak banks that were poorly governed and obviously needed to be reformed. And without reforming that banking system, the financial sector was going to continue to act as a source of drag on the growth. So we immediately began to work to put together a package of reforms. First, to work with the banks that had been identified as undercapitalized, for them to recapitalize or give them deadlines to ensure that they brought their capital adequacy ratio to the minimum of 10% at the time. We gave some of the banks 3 months framework within which to bring capital ratios back to 10%. And then those that were significantly undercapitalized, we had to work with them to improve their levels of capitalization within 3 months. Unfortunately for us, we had 2 banks that were so severely undercapitalized that we had no other option but to revoke their licenses. Now, you're looking at a sector in which there had been liberalization for over 20 years. There hasn't been any license revocation in the sector. This was almost a completely new policy. The players in the financial system were people of quite some stature. So it was almost unheard of to hear that a license of the bank was going to be revoked. But this is the decision that we had reached in August of 2017 to revoke the license of 2 banks. And the drama that goes with shutting down a bank, those of you who have seen this before, this involves using security to, in a sense, secure the premises of the bank, to secure the branches of the bank, and then letting the public know that this bank's license has been revoked. We had to organize a press conference to inform the public. This was very surprising for many onlookers in Ghana because we hadn't seen anything like that in the last 20 years. So we were confronted with a financial system that was almost non-performing, with very weak institutions that needed to be cleaned up, that needed the weaker institutions taking out through the revocation of their licenses. And then the question of what do you do with the depositors' funds, with those institutions whose licenses have been revoked. So we had to undertake what is called the purchase and assumption transaction, where we use the dominant state bank in Ghana, which is being operated on the basis of market principles, the Ghana Commercial Bank, to assume the assets and liabilities of those 2 failed banks. And the government had to step in to issue a bond to guarantee the depositors' funds for those 2 banks. I think the decision to use a bank that was well spread out in the country, that depositors were familiar with, improved confidence, and we did not have any major difficulty with depositors accepting the arrangements that had been put into place to allow them to access their deposits in the bank that had done the purchase and assumption agreement. And this is one of the points where Ghana has received quite a lot of credit to be able to revoke the license of 2 banks, and customers of the banks have been very calm. They have been very confident in the revocation procedure and the processes that allow them smooth access to their savings and funds in those institutions. And that's one of the issues that we think that was the most critical point, the ability to sustain depositor confidence whilst you go through cleaning up a banking system. Not too long after that, barely a year after that, we had a few other banks, 7 more banks, that we also had to revoke their licenses. This time, we did not have an assuming bank to take on the deposit liabilities of those 7 banks. Instead, what we did was to set up what we call a bridge bank. This is a completely new bank, more or less consolidate all the deposit liabilities of these 7 other banks whose license have been revoked. And that also get the government to issue another bond to make up for the difference between the good assets of the banks whose licenses have been revoked and their deposit liabilities. This time, I think the public was a little bit more used to the measure, and we were also again able to have this big bank revocation of licenses for 7 banks. And depositors were quite calm about it. We did not have queues of people trying to take their money out of the banks. All of this was done very smoothly. And I think that the confidence that the depositors imposed in the authorities reflected a lot of the work that we had undertaken prior to revoking the licenses of the banks. In line with standard practice, we needed to, in a sense, carry out a post-mortem, even though we were aware that the banks had weak capital and were short of capital. We needed to understand what was really driving the losses in the banks and why we had banks that were almost insolvent in the system. It turns out that the issue of corporate governance was a major problem in the Ghanaian banking sector, quite apart from the economic weaknesses, quite apart from the issue of weaknesses in supervision and enforcement of prudential relations. The corporate governance was also very weak. A lot of the shareholders and directors of the banks were using depositors' funds to finance their own businesses. There was a lot of insider dealing, related party transactions in excess of statutory limits. Risk management practices were poor in the bank. The shareholders and directors were indebted to the bank. That is, they were borrowing way in excess of limits from the banks that they were running. And some of the related parties had overborrowed also from the bank, in addition to the issue of weaker supervision during that period. So over this time, we have had to relook at the entire corporate governance arrangements in the banking sector, introduce reforms to also strengthen capital by raising the minimum required capital for banking from around 120 million Ghana cedis to nearly 400 million cedis. This is an exercise that has different dimensions. It involves a cost to taxpayers who have had to issue bonds to more or less keep depositors' funds in place. In terms of the cost of the resolution, it's cost us at almost 3% of GDP. However, we were able to save deposits of almost 1.5 million people who had depositors in these institutions. In terms of the regulatory framework, we had to issue a new capital requirements directive. We've issued a new corporate governance directive, which has rules on the way directors ought to behave. We've issued the Fit and Proper Persons Directive. We've issued a Mergers and Acquisition Directive, as well as some directives on cyber security and information security. All of this with a view to strengthen the financial sector more broadly. Now, let me quickly say that the problem was not only with the banks. The problem was also with the other non-bank institutions in the financial sector. In Ghana, we also have the savings and loans and finance houses. We have rural banks. We have the microfinance institutions as well, with similar difficulties. A lot of these institutions were very weak, without any capital. A lot of them had no liquidity and had taken deposits from individuals. So we also, after finishing up the cleanup of the banking system, we also needed to implement another set of reforms for the non-banking sector as well. By the time we were finished, we had closed up almost 347 microfinance institutions and about 23 savings and loans institutions, as well as 39 microcredit companies. These institutions were all insolvent, they were illiquid, and then the government had to issue additional bonds in order for the receiver that was put in charge of the resolution to be able to pay depositors their funds. The challenges identified included, again, low levels of capital, excessive risk-taking, poor use of depositors' funds, corporate governance weaknesses, creative accounting practices, and under-provisioning for impaired assets. So by the end of last year, which was 2019, we had completed a cleanup of Ghana's financial sector, nearly taking out 9 banks and a host of other non-bank financial institutions. We have seen significant improved outcomes in terms of financial sector indicators since the cleaning up process ended. Improvements in access to funds from the banks, improvements in access to funds with unresolved financial institutions. If you look at the before and after, perhaps you would see that there has been a clear improvement in the post-cleanup period. And the survey work that we did suggested that we are seeing restructuring and reform has been very useful, and it has seen significant improvements in the stability and soundness of the financial system. The last time we did a review of the numbers, we are seeing improvements in profitability in the banking sector. The banks are more liquid, they are more profitable, the capitalization levels are high. Average capital adequacy ratio was almost 18% relative to a threshold of around 10%. So let me try to, I see that I'm running out of time. Let me try to bring my presentation to a close to say that the cleaning up of Ghana's banking system, in a sense, has helped us to put the financial sector in a stronger position to be able to deal with this COVID-19 pandemic, which is a global health problem, which has translated into an economic crisis, impacting on growth. The IMF and World Bank are projecting a negative growth for the global economy for 2020 and 2021. Most central banks and fiscal authorities have implemented policies in a sense to manage the impact of COVID-19 on job losses and growth through quantitative easing, through reductions in interest rates, and through other government programs addressed at minimizing the impact on households. The response in Ghana has not been any different. We have had to reduce our policy rate by nearly 150 basis points. We have reduced reserve requirements to improve liquidity to the banks. We have relaxed the provisioning requirements for banks. We have asked the banks to, in a sense, give 6 months moratorium for loans to the private sector, all in a bid to reduce the impact of the COVID pandemic on credits allocation in the economy. So we have seen policy easing with policy rate cuts, foreign currency interventions, and also we have, in a sense, increased our lending to support small and medium enterprises and the lower loan loss provisions. And then we have also eased capital conservation buffers for banks. We are confident that the policies that we have put into place would help minimize the impact on the pandemic on the growth prospects for Ghana.